Welcome back. It could be a choppy start to a shortened trading week this week. Take a look at futures this morning, indicating a sharp sell-off at the start of trading, down 200 points right now. This comes after the Dow ended last week in positive territory. Joining us right now to look at markets is ETF Trend CEO Tom Lydon. Tom, good to see you. Thanks so much for being here.
Great seeing you, Maria.
So what's going on in terms of these wild swings? Do you think investors are getting used to these massive big moves at the start and end of trading?
Well, actually, it's been really healthy if you look at it from a fundamental standpoint. First of all, when earnings, 75% of companies have beat expectations. That's been great. Also, from a technical standpoint, markets came down to the 200-day moving average. Perfect. We've had more than a 50% retracement. And when you look at the ETF space, we've had record flows in January. And even though during that correction period, we saw about $25 billion go out, most of it was in the biggest ETF, SPY, which is about $19 billion. So, again, not a lot going on. Comfortable markets. A little more volatility than we've seen.
Where are the flows right now?
Most of the flows, surprisingly, this last year have been outside the U.S. in developed markets and emerging markets. U.S. investors have had that home country bias where we've been really comfortable with the growth that we've seen, but we're seeing valuations overseas pick up.
Which emerging markets should investors be rethinking? You know, it's a monolithic phrase, emerging markets, and you say we've got kind of this 10-year-old fixation, but today, I mean, what emerging markets in particular are you looking at?
Yeah, so you can go into ETFs, which is one of the great things about ETFs, and select certain countries. But most people don't know exactly what to do. So when you look at emerging markets, they're pretty diversified. And most importantly, China. And when we see earnings this morning, when we see Walmart and you see Home Depot, their biggest challenges in the future are going to be online. And that's where all the business is. That's where all the growth is. So when you look at Tencent and Alibaba, if you don't have those types of companies in your portfolio, grab some emerging market ETFs, especially when PE is around 12 compared to 20 here in the U.S.
Wow, 12. Where's the PE of 12?
In China, India, even a lot of Russian stocks. A couple of the ETFs that we're looking at this morning, there's a PowerShares Momentum ETF, EEMO, PE of 12. S&P Dividend ETF, EDIV, PE of 12. It's amazing when you look at, because we don't talk about it much. We always talk about the U.S. Yeah.
What have you seen in terms of outflows from bond funds, whether it's diversified bond funds, investment grade, exchange traded funds as well? Because again, if the demand isn't there, we've got a Treasury that's auctioning more than $250 billion worth of Treasuries just this week. Yeah. So as we're running bigger deficits and the portfolio of the Federal Reserve, the balance sheet is being unwound, you're going to have a lot more supply, a lot less demand. What do you see in terms of individual investor demand in ETFs?
Yeah, so a great point, Dagan. As we see this 10-year creeping up to that emotional level of 3% yield.
Look, it's pretty doggone close this morning.
No, it's amazing. So there's a lot of money that's coming out of Treasuries because they are most at risk when we see rising interest rates. But historically, corporates and high yields have actually done quite well during rising rate environments. So we are seeing more money go into those areas as opposed to Treasuries, and also diversified like the Barclays Ag. There are a lot of Barclays Ag related ETFs that are out there that are doing pretty well. The big thing, I think, investors are looking for yield outside of fixed income. As we mentioned, emerging markets, but there are a lot of companies that have great yields that are close to 3%. So people are moving money more from the fixed income space over to the growth and equity space to maybe match that yield.
This market is really still acclimating to, higher interest rates. We just saw the 30-year at 3%, above 3%, and the 10-year at 2.9%. What's your expectation for the U.S. market as this market continues to digest the expectation that we're in a higher yield environment and we're going to continue to be so?
Well, finally, I mean, for 5 years we've been talking about rising rates, and I think finally we're to the point where it's in fact going to happen. But again, as we point out, over periods of time when we've had a nice growth environment, inflation starts to kick in, we've got balance with the Fed and how many times they're raising rates. As long as we have this kind of Goldilocks environment, we should be just fine.
I wanted to ask you about that. You mentioned inflation. inflation, and Robert Samuelson, the economic writer for the Washington Post, he was just writing this morning that he's worried about inflation and that it could be leading possibly to a financial crisis on par of 2008, 2009. Do you have this?
That's garbage, by the way. Can we just point out that Robert Samuelson's writing that the inflation risk is going to lead to a 2008-like financial crisis? I haven't read the article, but that doesn't make me want to read it.
It's out this morning. So, what are your views about this?
Well, I think, our gas prices going up at the pump. Are you paying more for milk? A little bit. We're seeing
the consumer's going to feel that.
We're a little bit, but also does the tax break balance it out for most people? Maybe. Those are things I think we need to consider. There's nothing from an inflationary standpoint that's off the charts. Wage growth is increased, which is all positive. Housing prices are increasing, but not to a rate where the Fed's having to come in and put the brakes on. I think right now it's been kind of balanced.
By the way, we should point out that Home Depot just raised its dividend. We're seeing companies raise their dividend with that's how partly they're paying off or passing on the savings of the tax plan. And you mentioned a dividend ETF. In terms of investing in the U.S., are you avoiding that right now? Because you're talking a lot about international. Or are you looking for dividend payers?
I think the best thing I can do is maybe an educator is say, look, if you've got a home country bias, if you've got most of your money allocated or correlated highly with the S&P 500, you're really happy. But if you don't have an allocation outside the U.S., now's the time to think about it. It's really important to make sure you're diversified and not just continue to run with the winners.
Yeah, especially since we're looking at the story in the Journal you and I were just talking about Macron attacking the labor market. That's exactly one of the things that he had to do in France.
That's a really, really good news story for France. I mean, when you look at a story like that, do you see opportunities in Europe that haven't been there over the past several years? Because you've had such bloated bureaucratic government, stifling economic growth. Now we're talking about a fairly revolutionary policy in France.
Yeah, they're playing, France is playing catch up. A lot of these developed nations.
They want to cut taxes now, too.
Right, and then is Brexit going to be rolled back? There's a lot of talk about that as well. Who knows? But here in the U.S., we're in pretty solid shape, fundamentally and also from a market standpoint. There's a lot of room to grow in these developed nations, and most importantly, you got to watch emerging markets. If you don't have emerging markets in your portfolio, you'll regret it 5 years from now.
There's no specific reason for a 200-point sell-off this morning that anyone can point to. I'm looking at some of the trading desk notes this morning, and J.P. Morgan is just telling clients, look, this is a continuation of investors understanding and digesting this higher yield environment.
The Journal wrote over the weekend, though, that the market came back so rapidly, and we had such an incredible week last week, 6 straight days of gains, the Dow having its best week since the presidential election in 2016, that it was just too much too fast, and it throws people off, and it puts them on edge, and I think that you're seeing that this morning.
Yeah. Well, I think we're going to start talking about taxes real soon, and the benefits of that, and that's going to be really important to the average investor. Hey, we're getting into spring. Before we know it, blooms will be on the trees, and that'll be nice. But, boy, we've had a nice volatility here in the market for the first time. It's kind of woken us up. However, I'm having a tough time finding weakness in markets today.
All right, we will leave it there. Tom, good to see you.
Good seeing you, Maria.
Thank you so much for joining us. Tom Lydon joining us there.